So if you wanted to build a skyscraper, right, you wouldn't just show up to an empty dirt lot with a pile of steel beams, maybe a cement mixer, and a hard hat, and just, start guessing where things should go.
Right, that would be a complete disaster. You need a master blueprint.
Exactly. You need a schematic that dictates exactly where every single rivet, every electrical conduit, and every pane of glass is supposed to live.
Because without that blueprint, you just have a very dangerous, very expensive pile of raw materials sitting in the mud.
Yeah, exactly. Now, take that entire concept of building a massive skyscraper, and I want you to shrink it down until it is roughly the size of your thumbnail.
And instead of using steel and concrete, you're building this city out of silicon.
Right. You still need a blueprint to tell the factory exactly how to construct that microscopic city of transistors.
Yeah.
But how on earth do you print a blueprint that is measured in nanometers?
Well, you use a highly specialized, incredibly complex tool called a photomask.
A photomask. And the company that controls the manufacturing of those masks effectively controls the entire global flow of microchips.
Which, puts them in a really fascinating and sometimes precarious position in the broader tech ecosystem. I mean, they sit at the absolute tip of the spear of semiconductor manufacturing.
Welcome to a very special Talk Tickers edition of The Deep Dive. We are speaking directly to you, the listener, today.
Yeah, thanks for joining us. We're here to break down the Q2 2026 earnings call for a company called Photronics.
Right, ticker symbol is PLAB. And our mission today is to give you a really data-forward, opinionated breakdown of their latest quarter.
And look, Photronics is not a household name, right? You won't see their logo stamped on the back of your smartphone.
No, definitely not. Or slapped across some high-end graphics card. But they are this invisible, critical backbone of the tech world.
Because they manufacture those photomasks we just talked about.
Right. Okay, let's unpack this. Because to really understand the stock, we have to look under the hood at the raw data from this quarter. So total revenue came in at $210 million.
Which is, it's essentially flat year over year, and actually down sequentially from a pretty strong Q1.
Yeah, and in the kind of growth-obsessed market environment we're in right now, flat revenue immediately triggers alarm bells, doesn't it?
Oh, absolutely. Institutional investors see flat revenue and they panic. But that top-line number actually masks a pretty severe divergence inside the actual business itself.
Right, because Photronics essentially operates in two distinct markets.
Right.
The first is IC, or integrated circuits. This is basically the microchip side of the house.
And that segment brought in $148 million, which makes up about 70% of their total revenue.
And here's where the data gets incredibly specific and honestly a bit concerning. Because that IC revenue was actually down 5% year over year.
Yeah, it was. Mainstream IC was $91 million, and the high-end IC represented about 38% of the total IC segment.
So the core microchip business is shrinking. But then you have their second segment, right? FPD, or flat panel displays.
Which is the glass side of the business. The screens for smartphones, laptops, televisions, all that.
Right. And FPD revenue was $62 million, which is up an incredible 13% year over year.
It's a huge split. The display business is surging, literally posting one of the strongest quarters in the history of their operations.
While the microchip business is just unexpectedly contracting, which we'll get into because the market dynamics driving that split are fascinating.
Definitely. But before we get to the why, we also need to contextualize their profitability numbers.
Good point. So gross margin came in at 31%, and operating margin was at 20%.
Which, those are relatively healthy margins, but let's look at the earnings per share because there is a massive quirk in the data here.
Oh yeah, the EPS quirk.
Right.
So diluted GAAP EPS was $0.54 per share, but the non-GAAP diluted EPS was only $0.42 per share.
Right. And usually companies lean really heavily on non-GAAP numbers to strip out restructuring costs or stock-based compensation.
Yeah, they use non-GAAP to make their core operations look more profitable than the official accounting rules allow.
Exactly. But here, the non-GAAP core business number is actually significantly lower than the GAAP number, 12 cents lower to be exact.
Right. Now, knowing that Photronics operates massive manufacturing facilities in Taiwan and Korea, this points directly to currency fluctuations, right?
Yes, it's all about foreign exchange.
But wait. How exactly does a swing in, say, the new Taiwan dollar or the Korean won artificially inflate the bottom line of a US-based mask maker? 12 cents a share is a lot.
It is a lot. So it comes down to how global assets are translated on a balance sheet at the exact end of a quarter.
Okay, walk me through that.
Well, Photronics holds substantial cash reserves and accounts receivable in local currencies in Asia. They have to, right, to pay their local workforces and local suppliers.
Makes sense. You can't pay a factory worker in Taipei with US dollars.
Right. So when the US dollar depreciates relative to those Asian currencies during the quarter, the paper value of those foreign holdings increases.
Ah, I see. When they translate it back into USD for the official earnings report.
Exactly. It is a completely non-operating paper gain. It's not cash they earned from selling more products.
It's basically an accounting illusion caused by the exchange rate.
Yeah, an FX casino, basically. So management is providing that 0.42 non-GAAP number to strip out the noise.
To show what the actual underlying engine of the business, selling photomasks actually produced.
Exactly. And honestly, that underlying engine is still generating a lot of cash.
Yeah. Operating cash flow was $47 million, which is a very solid 22% of total revenue.
And if you look at the balance sheet, it shows them sitting on $638 million in cash and short-term investments.
Wow. Which on paper looks like a massive war chest, right? Like they could deploy that for huge share buybacks or special dividends?
You'd think so, but this is where a critical detail from the footnotes comes in. It completely changes the picture.
Right, the joint venture structure.
Yeah. Of that $638 million, $477 million is actually held within their joint ventures in Asia.
Okay, so why does that matter? If they claim it on their balance sheet, don't they own it?
Well, Photronics holds a 50.01% ownership interest in those entities.
Oh, so just barely over half.
Right. But that tiny fraction of a percent gives them controlling interest. So accounting rules say they have to consolidate the entire cash amount onto their own balance sheet.
But they can't actually just unilaterally raid that piggy bank whenever they want, can they?
Not at all. That cash belongs to the joint venture. And that joint venture has its own capital expenditure needs and, minority partners who have a say.
So the true, free and clear liquidity at the parent company level is actually significantly tighter than the headline number suggests.
Exactly. It drastically changes how you should value their liquidity buffer if you're holding the stock.
That's a great catch. But I want to pivot back to that revenue divergence we flagged earlier because it genuinely confuses me.
The IC versus FPD split.
Yeah. I mean, look around. We are sitting in the middle of an unprecedented artificial intelligence boom, right? Data centers are scaling at light speed.
Oh, absolutely. The spending is off the charts.
And the demand for leading-edge logic and memory chips is seemingly insatiable. So if Photronics is the printing press for the semiconductor industry, and the industry is literally printing money right now, how in the world is their IC revenue down 5%?
It's a great question. And to reconcile that, you really have to look at the exact mechanism of how Photronics actually gets paid.
Okay, so it's not a volume game.
No, not at all. They do not collect a royalty on every chip sold. They honestly don't care if a foundry stamps out 10,000 chips or 10 million chips from their mask.
Wait, really? So volume doesn't matter to them?
Not for revenue generation. They make their money at the exact moment of something called tape out.
Tape out. Okay, define that for the listener.
When a semiconductor design firm like an NVIDIA or an AMD finalizes a brand new chip architecture, they send those digital files to the foundry.
Look at TSMC or Samsung.
Exactly. And at that exact moment, an order is generated for a new set of physical photomasks.
Okay, so Photronics delivers that custom mask set, gets paid once for the delivery, and then basically steps out of the picture for that specific chip generation.
That's it. So their revenue is completely unlinked to the total volume of chips manufactured globally.
Wow, okay. So it is entirely dependent on the velocity of new designs being introduced to the market, not the volume of old designs being printed.
That is the absolute linchpin of the whole business model.
Mm-hmm.
And on the call, management cited 3 specific macroeconomic headwinds that have effectively paralyzed that velocity.
Paralyzed the velocity of new design releases, meaning completely stalling the tape-out pipeline. Yeah. So let's hit those 3 headwinds. What's the first one?
The first headwind is elevated foundry utilization rates.
Okay, I want to visualize this for everyone listening. Imagine a massive automotive plant, right? And it's currently running 24 hours a day, 3 shifts, just churning out their best-selling SUV.
Right, just trying to keep up with current customer demand.
Yeah, every robot is active, every single assembly line is fully booked, and then the R&D department shows up at the factory door with the blueprints for next year's model.
Which is great, but to switch over to that new model, the plant manager would have to literally halt the lines.
Exactly. Halt the lines, recalibrate the robots, run test batches, and basically suffer weeks of downtime.
And the plant manager refuses to do that. The factory is making way too much money today to sacrifice time retooling for tomorrow.
Right, and that is precisely the dynamic occurring inside the world's largest semiconductor fabs right now, isn't it?
It's spot on. Fabs are immensely capital intensive. I mean, they cost billions to build, so their profitability relies entirely on minimizing downtime.
And because demand for current generation chips, especially AI accelerators, is so extreme, the foundries are just prioritizing high volume production of existing designs.
They have literally run out of floor space and operational bandwidth to allocate engineering time to integrate new designs.
So the chip designers are sitting there ready with their next generation blueprints, but the factories are refusing to accept them until current demand normalizes a bit.
Exactly. The tape out is delayed, which means the mask order is delayed, and so Photronics revenue drops.
And it is a bizarre scenario where the industry is almost too successful for its own good. The backlog of current orders is literally suffocating future innovation.
It really is. And that brings us to headwind number 2, which is memory constraints.
Right. Management specifically noted surging memory prices and supply shortages. But help me connect the dots here. If I am an OEM building, say, a smartphone, how does a spike in the cost of a DRAM chip prevent me from ordering a new photomask?
It destroys the unit economics of your final consumer product.
Okay, how so?
Look at the bill of materials, the BM, for a mid-tier smartphone or maybe a smart home appliance, particularly in the lower margin Asian market.
Right, those manufacturers operate on razor-thin margins to begin with.
Exactly. So if the global spot price for memory suddenly spikes because of supply chain tightening, the total cost to manufacture that specific device surges past the break-even point.
So the phone is literally no longer profitable to sell at its target retail price.
Right. So the OEM's chief financial officer steps in and just halts the entire product launch. They decide to hold off and wait out the memory market volatility.
And if the device launch is delayed, the custom logic chip that was designed to power that device is also put on ice.
Yep. The tape out is paused indefinitely. So the memory market is acting as this massive drag on the broader consumer electronics ecosystem.
It's halting the cadence of new product introductions across the board.
Exactly.
Okay, so that covers the manufacturing bottlenecks and the supply chain cost issues. What's the third headwind?
The third headwind management introduced is geopolitics.
Right, and I want to be clear to the listener here. We are impartially reporting this factor exactly as management stated it on the call, as a market headwind. We aren't taking a political side or editorializing the conflict itself.
Right. Management specifically cited the U.S.-Iran conflict as a catalyst for macro uncertainty that is impacting their order flow.
So let's look purely at the logistics and the corporate psychology here. How does a conflict in the Middle East actually freeze a tape-out budget in a Taiwanese or an American design firm?
Well, a tape-out for an advanced node chip is an exorbitant capital expenditure. I mean, we are talking millions, sometimes tens of millions of dollars.
Just for the initial setup, the mask set, and the qualification wafers, right?
Exactly. It represents a massive, irreversible commitment of corporate capital. So when geopolitical flare-ups occur, particularly in major energy-producing regions, it introduces immediate supply chain anxieties.
What are these CFOs actually worried about specifically?
Chief financial officers look at the potential for, say, surging freight insurance premiums or rerouted shipping lanes that drastically increase transit times.
Right, or massive spikes in the cost of the raw energy required to run these power-hungry fabs.
Exactly. The environment basically becomes impossible to model accurately.
And uncertainty is the enemy of discretionary capital expenditure.
100%. Instead of pulling the trigger on a massive new tape-out, executive boards just choose capital preservation.
They hold their cash and delay the transition to the next technology node until they have clear visibility into global logistics and energy costs.
Right. So you combine all three of those factors.
Foundries with zero capacity to retool, skyrocketing memory costs, crushing the margins of consumer electronics, and CFOs hoarding cash due to geopolitical anxiety.
Exactly. And you have this suffocating headwind sandwich. It perfectly explains why microchip design tape-outs basically fell off a cliff right after the Chinese New Year.
A headwind sandwich. I like that. But wait, if that headwind sandwich is so oppressive across the tech sector, why is their flat panel display segment seemingly immune?
That's a great question.
I mean, they posted $62 million in revenue there, up 13%. That implies the display manufacturers are operating in an entirely different reality.
They really are operating under fundamentally different market dynamics. And that segment is heavily concentrated in China and Korea.
Okay, so what's driving the display side?
First, the FPD segment is tightly levered to really high-end consumer electronics. We're talking flagship smartphones and premium smartwatches destined for Western markets.
And those premium devices carry massive retail markups.
Right. A company selling a $1,000 phone has the margin buffer to absorb a spike in memory costs without delaying their entire launch schedule.
Oh, that makes perfect sense. They just push forward, meaning their demand for high-end display masks remains really rigid.
Exactly. But there's a bigger technological shift happening too. Management spent a lot of the call discussing a massive structural shift in the display industry itself.
Right. They talked about moving toward AMOLED technology and something called Generation 8.6 glass.
Yes, the G8.6 transition.
Now, I know AMOLED provides those incredibly deep blacks and vibrant colors on modern screens, but what is the mechanical significance of Generation 8.6? And why does it drive so much revenue for Photronics?
So, generation in the display industry just refers to the physical dimensions of the mother glass.
Okay.
Because display manufacturers, they do not build screens one by one. They pattern massive single sheets of glass and then slice them down into individual phone or laptop screens later.
Right. So what size is a Generation 8.6 mother glass?
It is roughly 2.2 meters by 2.6 meters. It is literally the size of a large garage door.
Wow. Okay, so by upgrading their factories to handle this massive piece of glass, the manufacturers drastically reduce wasted material and improve their unit economics.
Exactly. But think about the tooling. To pattern circuitry onto a piece of glass that large, you need a photomask that matches it.
Oh, wow. A photomask the size of a garage door.
And this is where the physics becomes staggering. You are taking a pure quartz mask the size of a garage door and using electron beams to etch microscopic, flawless patterns across its entire surface area.
The precision required for that. I mean, the thermal expansion of the material alone, the vacuum handling, the defect tolerance.
The degree of difficulty is exponential. Very, very few companies on Earth possess the specialized lithography equipment to manufacture a high-end G8.6 AMOLED photomask.
And Photronics is one of them.
Right. Photronics recently installed an FPD masquerader specifically to capitalize on this exact trend.
So as the entire Chinese and Korean display industry races to upgrade their fabrication plants to the G8.6 standard, they essentially have no choice but to purchase entirely new, highly complex, very high-margin mask sets from Photronics.
Exactly. So while the microchip designers are sitting in a traffic jam waiting for fab capacity, the display manufacturers are basically laying down new highway.
They're upgrading their entire fleets to G8.6, and Photronics is the premier supplier of the necessary tooling. That diversification is literally saving their top-line revenue right now.
It absolutely is.
But as investors, we need to look at management's roadmap for the future.
Yeah.
And looking at their Q3 guidance, the roadmap looks pretty muddy.
It really does. They guided Q3 revenue between $207 million and $215 million.
Which signals that the tape-out slowdown is persisting right into the next quarter.
Yeah. And they project operating margins will slip to between 18 and 20%, and non-GAAP EPS will land somewhere between $0.39 and 75 cents.
So they're telegraphing very limited visibility and maintaining a highly defensive posture.
Very defensive.
But this is where I really have to push back on their capital allocation strategy.
Okay, let's hear it.
If revenue is flat, visibility is zero, and operating margins are already slipping. How do they justify maintaining their fiscal 2026 capital expenditure at a massive $330 million?
That's a huge number.
Right. They were pouring hundreds of millions of dollars into facilities in Boise, Idaho, and Allen, Texas. And think about the accounting mechanics of that.
The depreciation hits.
Exactly. The moment you purchase and install highly specialized lithography equipment, you have to begin depreciating it. It's like running the engines of a massive cargo jet while it sits idle on the tarmac.
Yeah, it's burning cash in the form of depreciation, whether it is actively producing masks or not.
Exactly. Won't this CapEx just crush their margins in a weak demand environment? Are they basically building a mansion in the middle of a housing recession?
It is a severe risk. And to be fair, it was directly challenged during the Q&A session by the analysts on the call.
How did management respond?
Well, Photronics operates with an intensely fixed cost structure. Management admitted they have very few levers to pull to reduce operational expenses in the short term.
So they can't just turn off the lights and save money.
No. However, you really cannot view this $330 million spend through the lens of a single week quarter. This is a multi-year infrastructural play.
Okay, so what's the long game here?
The expansion in Allen, Texas is already well underway. They are beginning qualification masks in Q3. Halting a state-of-the-art clean room construction project midway through completely destroys capital efficiency.
Yeah, that makes sense. You cannot abandon a half-built factory just because order flow dipped in May.
Right.
But what exactly are they building in Allen? Is it just raw volume capacity, or is it a technological upgrade?
It is a fundamental node transition. They are qualifying the Allen facility to produce advanced 8-nanometer and 7-nanometer masks.
Geometries it previously could not handle at all.
Exactly. And this creates a highly strategic cascading effect across their entire U.S. footprint.
How so?
Well, currently, their facility in Boise, Idaho, handles all their bleeding-edge U.S. orders. But by bringing Allen up to the 7-nanometer standard, they can essentially offload the quote-unquote lower end of the high-end work from Boise down to Texas.
Oh, I see. Freeing up the equipment in Boise to focus exclusively on the absolute highest margin, most complex mask sets. They're optimizing their internal supply chain.
Exactly. But honestly, the more pressing macroeconomic driver for this $330 million spend is the generational shift towards semiconductor onshoring.
Right. Directly catalyzed by the U.S. GHES Act.
Yes. Western governments have fundamentally realized that concentrating the manufacturing of critical technology in Asia is a catastrophic national security vulnerability.
So billions of dollars are being deployed to build massive state-of-the-art foundries in places like Arizona, Ohio, and Texas.
Right. And think about the supply chain for those new fabs. If you are building a $40 billion fab in the American Southwest, you cannot rely on shipping your delicate, hyper-precise photomasks back and forth across the Pacific Ocean.
No way. The logistics, the security risks, the time-to-market delays, it's just unacceptable. You need a localized supply chain.
You need a world-class mass supplier on the exact same continent.
And management stated their ambition very clearly on the call, didn't they? They intend to be the primary photomask supplier in the United States.
Yes. So this CapEx is an aggressive land grab. They are enduring the short-term pain of depreciation and margin pressure right now to guarantee they are the indispensable onshore partner.
When that tidal wave of U.S. fabrication capacity finally comes online over the next 3 to 5 years.
Exactly.
Okay, that makes the CapEx much more palatable. But they also mentioned a strategy to capture, quote, increased outsourcing opportunities from captive photomask producers.
Right, the captive versus merchant dynamic.
Let's define the mechanics of that for the listener.
Okay.
A captive mask shop is when a massive foundry, the giants manufacturing the chips for Apple or NVIDIA, chooses to manufacture their own photomasks in-house rather than buying them from a merchant supplier like Photronics.
Yes, and they do this to maintain absolute tight control over their proprietary lithography processes.
Historically, yes. But as the industry pushes down into extreme ultraviolet lithography at the 7-nanometer, 5-nanometer, and now 3-nanometer nodes, the physics of mask making change drastically, don't they?
They do. The cost of the electron beam writers and the inspection tools becomes astronomical.
And the defect tolerances shrink to literally the atomic level, which drives down yield rates.
Right. It becomes a highly specialized nightmare. So it becomes economically irrational for these foundries to maintain captive mask operations for every single layer of a chip.
Because a modern chip might require, 80 different masks?
Easily. Perhaps the foundry keeps the 3 most critical bleeding-edge layers in-house to protect their IP, but they outsource the remaining 77 layers.
They push the capital burden and the yield risk onto a specialized merchant supplier.
Like Photronics. So Photronics is upgrading the Allen facility to ensure they have the exact technological specifications required to absorb that highly profitable, outsourced 7-nanometer overflow from the captive shops.
Wow. Okay, so synthesizing everything we've discussed today. The top-line numbers, the tape-out headwinds, the massive U.S. onshoring strategy. What is the actionable takeaway for a retail investor looking at Photronics today?
Well, to model this company, you really have to understand the terrifying velocity of their operations.
Yeah, management disclosed that their typical backlog is only 1 to 3 weeks, which is wild.
It is an incredible operational tightrope. Imagine managing a global manufacturing footprint, employing thousands of technicians in multi-million-dollar clean rooms, and you only have visibility into what you will be producing for the next 21 days.
It's anxiety-inducing. But it's just the nature of the tape-out process, right?
Yeah.
Design firms do not order a photomask 6 months in advance.
No, the order is triggered the exact day the digital design is finalized, and then they demand physical delivery of the mask within days.
So Photronics operates as a hyper-advanced short-order cook.
Basically, yeah.
Right.
But because the average selling prices, the ASPs for these high-end 7-nanometer masks are so incredibly high due to the low yield rates and complexity, a massive amount of revenue is concentrated in a tiny handful of orders.
Which creates extreme quarter-to-quarter volatility.
Right. If an OEM delays a flagship product launch by just 14 days because they are worried about DRAM pricing, that massive tape-out order slides from Q2 into Q3.
The fundamental demand for the mask didn't disappear, but the revenue recognition shifts.
Exactly, causing a severe miss on Wall Street's quarterly estimates.
Okay, so this dictates a very bifurcated view on the stock. If you're listening to this and looking at the short term, the next 3 to 6 months, the stance really has to be deeply cautious, if not outright bearish.
I agree. The company is trapped in that headwind sandwich. You have margin compression accelerating due to the heavy fixed depreciation costs of their new facilities colliding with completely flat revenue.
You have the foundries choked with current orders, refusing to accept new tape-outs, and you have an unpredictable macroeconomic environment keeping CFOs highly conservative.
The post-Chinese New Year recovery they modeled simply did not materialize, and their current quarter guidance reflects a continuation of that stagnation.
So for an investor seeking a near-term catalyst or looking for a rapid swing trade, the lack of visibility makes Photronics a highly dangerous proposition right now.
It's just too murky in the short term.
But if you stretch your time horizon out to 2026, 2027, and 2028, the thesis inverts completely, doesn't it?
It does. I am incredibly bullish on the underlying mechanics of their long-term position.
Because the artificial intelligence revolution is not a fad. It is a structural shift in global computing.
Right. And AI fundamentally requires advanced logic architectures and massive high-bandwidth memory configurations.
And every single iteration of those architectures requires new, hyper-complex photomask sets.
The demand is not evaporating. It is simply dammed up right now behind the physical limitations of current founder capacity and temporary supply chain shocks.
Furthermore, the billions of dollars committed to U.S. semiconductor onshoring guarantee an explosive expansion of domestic manufacturing.
And Photronics is making the painful, really expensive capital investments today to ensure they own that onshore market tomorrow.
Coupled with their dominant positioning in the high-margin G8.6 AMOLED display transition over in Asia, the long-term revenue engine looks incredibly robust.
It really does.
So the actionable conclusion is clear. This is not a stocks for the impatient.
No. The next few quarters will likely feature sideways movement, volatile earnings, beats and misses, and heavy macro uncertainty.
But if you have a multi-year horizon and you want a foundational infrastructure-level play on the U.S. semiconductor renaissance and the proliferation of AI hardware, this is a classic hold. You are essentially waiting out the traffic jam.
Right. You are holding the stock for what happens when the current physical constraints of the industry are finally lifted.
Which leaves us with a final speculative mechanism to consider. A thought to chew on after this episode.
Okay, what is it?
We know that tape-outs are bottlenecked right now because global foundries are running at maximum utilization.
Right, no room on the floor.
But we also know that hundreds of billions of dollars are actively being spent to construct massive new fabrication plants worldwide.
The global footprint of factory floor space is expanding rapidly.
Exactly. So when those new fabs finally come online, drastically increasing global manufacturing capacity, the foundries will suddenly be desperate for new designs to fill their clean rooms, right?
Yes. The current refusal to retool will vanish overnight.
So when that capacity opens up, does the tape-out dam simply break? Do we see 3 years worth of pent-up, delayed AI and consumer electronics designs flood into the market simultaneously?
That's the billion-dollar question.
And if that unprecedented tidal wave of high ASP mask orders hits Photronics all at once, how aggressively will that operational leverage drive their bottom line?
That is the precise mechanism that long-term investors are waiting to see trigger. The inflection point could be violently profitable.
It is a systemic pressure cooker that we will be watching very closely. Well, thank you for joining us on this deep dive into the microscopic, multi-billion-dollar world of photomasks. Keep looking past the headline numbers, keep searching for the mechanics driving the blueprints, and we will catch you on the next deep dive.